Last year, in 2013, China surpassed the United States and became the world's largest trading country. However, it cannot overcome certain issues as its shadow banking sector and booming real estate market. Today, we are joined by Professor Yusaf Akbar from Central European University to discuss the prospects of the Chinese economy. Well, thank you, Yusuf, for seeing us once again.
Good to be here.
Last time when we spoke, we discussed the BRICS, and today I wanted to focus on one of those countries, China. Now, as China's GDP growth slowed down to 7.4%, the government should be more concerned with providing additional stimulus to the economy. At the same time, it is worthwhile mentioning that even though China is no longer experiencing the previous double-digit growth rates, many countries could still envy to have China's current growth. So, in your opinion, should 7.4 be a figure that is starting to cause and ring alarm bells? Or is it sufficient for China considering the global economic situation?
Well, first of all, I don't think anybody who's been following the situation in China will be in any way surprised that the economic growth rate will moderate. You start out with a situation where the Chinese economy grows rapidly because of coastal development on the East Coast. Obviously, as that part of China becomes developed, costs rise, input costs, labor costs, construction costs. So it's actually kind of natural that the Chinese economy should slow down. And of course, the Chinese government has invested heavily in trying to shift economic activity away from the East Coast to the central and western regions of China. They've built high-speed railway. They've provided significant investments and incentives for foreign investors to come to China. But the fact remains that China still needs trade to grow, and so its economic growth rate is heavily dependent upon what happens in the world economy. And as you say, I think most leaders of most economies would bite off your hand if you offered them 7.4% GDP growth. For a moment, just contrast China with India, right? There's just been an election in India. A centre-right coalition has been elected with an absolute majority, and one of the key issues in the election campaign in India was how do we come back from a 4% growth rate to a 9 or 10% growth rate. So in that sense, I think China's in a good shape.
There are potentially two bubbles that can burst in China. That's the shadow banking sector and the real estate bubble. So I wanted to discuss the two. So first of all, the shadow banking sector. It's valued at $4.4 trillion US dollars, nearly equivalent to nearly 1/5 of domestic bank sector total assets. And in 2000, 80% of all credit was provided by traditional banks, and the remaining 20 were supplied by shadow banks. By last year, the divide was 50-50. Now, do you think that the shadow banking sector has gone so far to the point that if the government attempts to deflate the bubble and begins deleveraging, the situation may backfire and the bubble will pop?
Well, it's interesting. Yes and no. So I think the Chinese finance ministry has been much more proactive than the monetary authorities of the United States or selected EU countries, in the sense that I think that the Chinese government are fully aware of this. They're very concerned that this shadow economy will develop. I think it's also a definitional issue, in the sense that I think that many of the activities that might be labeled shadow banking are actually mainstream banking in more developed countries. So, maybe if it's just a matter of the government saying, okay, we now recognize this form of banking as an acceptable form of banking. If I look at many of the issues facing the Chinese shadow banking sector, it looks exactly like the US banking sector, with these kinds of sort of hybrid financial institutions participating actively in finance, but they don't call themselves banks. I mean, GE Capital is one of the world's largest banks in the world, but they don't call themselves a bank, so they thereby bypass regulatory constraints on the few regulatory constraints that exist in the US on banking. So I think, I'm confident that the Chinese government will be able to take action quickly enough to slow this down.
Another mounting concern for China is the real estate market that has been supplied by the already mentioned shadow banking sector. And property investment accumulates approximately 20% of the country's GDP. But the problem, I think, in China is that most people cannot buy the homes, which results in so-called ghost cities, empty houses for miles. And the government is, though, trying to somehow prevent an overheating of the real estate market by loosening mortgage lending. But do you think the government is using the necessary tools to contain the potential bubble?
Well, I think these ghost cities, I think the phenomenon of ghost cities is a broader phenomenon than just the purely issue of regulation. They're building these cities out in Urumqi province, out in the far northwest of China, right up by Mongolia. There's no fundamental economic reason to build a city there. But I think that's part of a broader strategy of Beijing to populate the northwestern regions with Han Chinese as a counterbalance to the Islamic populations in the northwest. I think that's a political thing. But when it comes to this issue of housing bubble, I always believe that if you have credit growth, the best way to deal with credit growth is to introduce credit controls. So I know that's not fashionable in Europe and America that you would somehow place a quota on the supply of credit. But I think the collapse of the real estate market in the US in 2008 is a beautiful illustration of a shadow banking sector out of control without serious regulation such as credit controls. And I think that the Chinese government will introduce credit controls which will try and somehow slow it down.
And finally, if the situation does in China deteriorate, what unconventional options are there for China? Like we had QE in the US and Japan, which is rather non-traditional.
Quantitative easing is not new. It's printing money, and people just have to be clear about this, right? The US Federal Reserve and the Bank of Japan are basically pumping billions of dollars into the economy to somehow keep it from crashing. This is good old-fashioned monetary expansion. We have a fancy word for it. It's called QE, and perhaps the underlying inflationary conditions are different. So in other words, you can do QE in this environment because the inflationary pressures are very low. Whereas when we did that in the 1970s, inflationary pressures were very high, and so therefore that's why you got this sort of very high inflation rates. I don't think QE will particularly solve China's problem. I think it's more an issue of supply. And I think the Chinese government should sort of work very hard to try and constrain the growth of the banking sector through appropriate credit controls.
Well, thank you very much for your time.
Thank you.
And that was Professor Yusaf Akbar, who provided his expert opinion on China and whether the world's second largest economy is losing its steam. For other top news and headlines, stay tuned to Tukoscopy TV.